Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So this is the last and final video on receivables management. So last two videos I have completed 3 problems on receivables management. Here in this video 2 more problems. But the problems are based on theory. So my suggestion, first you should watch the theory video. Be perfect about what is receivables management, what is the importance of receivables management, how to evaluate the credit policies, what is factoring, what is aging schedule. All these are the concepts very important from examination point of view. So without understanding that, you should not go for the problems. So if you have not watched, I suggest you go to the playlist of my channel, select the subject financial management for BBA. Select the video of receivables management, be perfect, and then you can start the problem. Apart from this financial management, I have uploaded so many subjects videos like operation research, operation management, statistics for management, accounting for management, all these for BBAs and MBAs. And apart from that, for BCom, I have uploaded the videos for financial accounting, cost accounting, corporate accounting, management accounting, and taxation. And apart from that, statistics. All these are the videos you can find in my playlist. So visit the playlist, and for every video, if you are satisfied, give a like to the video, share my channel, and subscribe if you have not yet subscribed. And now, in this video, 4th and 5th 2 problems I am going to explain you. Before starting that, I expect my viewers to have a printout of the problems which I have given in the link under my description. Take the screenshot of the points, then I'll explain every point. Come on, see the problem number 4. The existing sales of private company are rupees 1 crore. The current customers are drawn from companies having high or good credit rating. With partially liberalized credit standard, the company's sales are likely to go up by 15 lakh. The mix of new customers 70% and 30% from the group rated as fair and limited respectively. So what are the contents of the problem? First of all, presently the sales are 1 crore and the company wants to liberalize the credit period. That means the credit policy the company wants to adopt is lengthening credit policy, increasing credit policy. If we increase the credit period, the sales will goes up. Here the sales are expected to go up by 15 lakh. And the new customers, 70% will be the new customers in that 15 lakh. And 30% from the group rated as fair and limited respectively. The average collection period is likely to be 45 days. And the incidence of bad debts losses are 10% for the new customers. And the contribution to sales ratio for private company is 20% and the cost of funds is 15%. Should the company follow the new liberalized credit policy? In this problem, how much credit period presently it is given? Not given. It is not given how many days are the credit period at present. But for the new liberalized policy, 45 days the company wants to give. So if the company gives 45 days credit period, then the sales are going to go up by 15 lakh. In that 15 lakh, 70% will be the new customers. And remaining 30% will be group rated fair and limited respectively. That means the new customers will be 70%. And the incidence of bad debts, if we adopt this new policy, the bad debts, irrecoverable debts are 10% from the new customers. And the contribution to sales ratio, contribution to sales just like profit volume ratio, PV ratio, contribution by sales into 100. So what is the percentage of contribution on sales? That is given as 20%. And the cost of funds is 15%, cost of capital 15%. Should the company follow the new liberalized credit policy? ultimate question whether the new policy should be implemented or not. So we'll make a trade-off between benefit and cost. The benefit is when we liberalize the credit policy, our contribution will increase. 20% is the contribution we are going to get. Actually, contribution is nothing but sales minus variable cost. Fixed cost will remain same. Whether we continue the old policy or we start the new policy, the fixed cost will remain same. So we ignore fixed cost. Ignoring fixed cost means we have to depend our decision on contribution. How much contribution we are getting. The contribution to sales ratio is given in the problem 20%. Now how to proceed with the solution? Now see here. Increase in sales is 15 lakh given in the new policy. And contribution to sales ratio is 20%. That means if sales are 100, the contribution will be 20. So contribution from additional sales. The new policy will give additional sales of 15 lakh. In that 15 lakh, 20% is our contribution. So 20% of 15 lakh, 3 lakh. So this is the benefit we are going to get from the new policy. 3 lakh rupees contribution is increasing, right? Now costs. The two costs are bad debts and the return on additional investment in receivables. So first of all, bad debts, irrecoverable debts. It is given in the problem 10% of new customers, not all customers, only on new customers. How much are the new customers? 70%. It is given in the problem. So total sales are 15 lakh. So 15 lakh ka 70%. It comes to 10 lakh 50,000 are the new customers. On this new customers, 10% is the bad debts. So 10% of 10 lakh 50,000, 1 lakh 5,000 is the bad debts expected. That means we are going to get the benefit of 3 lakh and the loss on bad debts is 1 lakh 5,000. Apart from that, we want the return on additional funds invested in receivables. That means from whichever source the company brings cash, it has to pay the cost. Like if loan is taken from bank, interest has to be paid. If loan is taken in the form of debentures, interest on debenture has to be paid. If shares are issued, dividends have to be paid. These are called cost of capital. That means the capital is not free, we are incurring cost. Similarly, when we make the investment in receivable, we want the cost of capital. In the problem it is given the cost of capital, the cost of funds are 15%. So first of all we calculate how much is the fund invested in receivables. Investment in receivables. When the contribution sales ratio is 20%, so the variable cost is 80%. Because sales minus variable cost is equal to contribution. Suppose if contribution is 20, that means 80 is the variable cost, 100 is the sales. For 100 rupees sales, 80 rupees is the variable cost, 20 rupees is the contribution, right? So 80% is the variable cost. So variable cost is 80% of sales, 15 lakh. So 80% of 15 lakh, 12 lakh rupees is the variable cost. Fixed cost is not given in the problem. So we calculate only on variable cost. The period of credit allowed 45 days. That means for 45 days our money is blocked in receivable. So assuming 360 days in a year, we calculate the investment in receivables. The total for 1 year variable cost is 12 lakh for 1 year. And here we assume to consist of 360 days for better calculation, easy calculation. We can take 365 also, doesn't matter. But if you take 360, we'll get a round figure. That's why we are assuming the number of days are 360 in a year. So we want for 45 days. For 360 days, our investment is 12 lakh. For 360 days. But we want only for 45 days. Credit period allowed is 45 days. So 12 lakh into 45 by 360, 1 lakh 50,000. 1 lakh 50,000 on an average is investment in receivables, right? Now return on investment in receivables is 15%. So calculate 15% of 1 lakh 50,000. It comes to 22,500. So two costs are there and one benefit is there. Benefit is the contribution. 3 lakh rupees contribution we are getting. But the cost is 1,05,000 is the bad debt loss we are going to incur, and 22,500 is the return on additional funds invested in receivables. Now we make a trade-off, set off between benefit and cost. So benefit, increase in contribution 3 lakh we have calculated. Costs, bad debt losses are 1,05,000 we have calculated. Return on additional funds invested in receivables 22,500. So add up 1,05,000 plus 22,500, 1,27,500. Now subtract 3 lakh minus 1,27,500. You will get 1,72,500. This is the net gain. Because contribution is more than cost. Benefit is more than cost. So that's why we are getting net gain. So ultimate suggestion, it is suggested to adopt the new policy of 45 days. New policy of 45 days, since it gives a net gain of rupees 1,72,500. That's all. This is the complete explanation of this problem number 4. Now, last and final problem, that is problem number 5. XYZ Limited is examining the possibility of relaxing its credit policy. Relaxing means extending. So whenever the credit policy is extended, the business will get the gain and also the business will incur some loss. Some benefit is there, some cost is there. So it presently sells 20,000 units at a price of 100 rupees per unit. Presently, the variable cost per unit is 88 rupees and the average cost per unit at the current sales volume is 92. All the sales are on credit. The average collection period being 36 days. Presently, a relaxed credit policy is expected to increase sales by 20%. Presently, how many units are sold? 20,000. If we adopt the relaxed policy, the sales will increase by 10%. So 10% of 20,000 is 2,000. So 20,000 plus 2,000, 22,000. That means presently we are selling 20,000 units. If we adopt the proposed policy, the sales will increase to 22,000 units. And the average age of receivables 60 days. Presently we are allowing 36 days. But new policy we have to extend it to 60 days. Assuming 15% return on investment, should the firm relax its credit policy? In this problem, the new point is bad debts are not given. So only one benefit is there, that is profit, and one cost, return on additional funds invested in receivables. That's what we have to calculate, right? So how to proceed? See here carefully. Present number of units 20,000 given and proposed number of units 20,000 plus 10%. So it will become 22,000 units. Average cost per unit is 92. From average cost, subtract the variable cost. The variable cost per unit is 88 rupees. So 92 minus 88, 4 rupees. That is the fixed cost per unit. Actually, total cost consists of fixed cost plus variable cost. So if we deduct the variable cost, the remaining cost is the fixed cost. So per unit fixed cost is 4 rupees. So presently how many units we are selling? 20,000 units. The total fixed cost is 20,000 units into 4 is 80,000. This 80,000 fixed cost will remain same whether we continue the present policy or we adopt the proposed policy. In both policies, fixed cost will remain same. Now in this tabular form, we calculate, we evaluate the proposed credit policy, right? Two columns I have opened at the extreme right hand side, present policy and proposed policy. Now first of all, credit period. Presently the credit period is 36 days given in the problem and proposed relaxed policy 60 days, right? Similarly, number of units. Presently the company sells 20,000 units and in the proposed policy it will increase by 10%, so it will become 22,000 units, right? Now sales, what is the selling price per unit? 100 rupees. So sales at the rate of 100 per unit, multiply 100 into 20,000, you will get 20 lakh. Similarly, 100 into 22,000, you will get 22 lakh. That is the sales. Now variable cost. Variable cost per unit is 88 rupees. Multiply 88 with number of units. 88 into 20,000, you will get 17 lakh 60,000. 88 into 22,000, you will get 19 lakh 36,000. That is the variable cost. Now fixed cost, it will remain same. How much fixed cost total? 80,000. The fixed cost 80,000, 80,000. Take the total variable cost plus fixed cost is the total cost. 17 lakh 60,000 plus 80,000, 18 lakh 40,000. 19 lakh 36,000 plus 80,000, 20 lakh 16,000. We got sales and we got total cost. We already know sales minus total cost is equal to profit. Here sales minus total cost is the profit. 20 lakh minus 18 lakh 40,000, 1 lakh 60,000 is the profit in the present policy. In the proposed policy, 22 lakh minus 20 lakh 16,000, 1 lakh 84,000. So presently we are getting a profit of 1 lakh 60,000. Proposed policy we are getting a profit of 1 lakh 84,000. Now investment in receivables. The total cost is 18 lakh 40,000 for 1 year. Now we assume there are 360 days in a year for easy calculations. So for 360 days total cost is 18 lakh 40,000. But our credit period is only 36 days. So for 36 days how much is the cost? So 18 lakh 40,000 into 36 by 360, you will get 1 lakh 84,000. This is the investment in receivables in the present policy. In the proposed policy, 20 lakh 16,000 into 60 by 360, because number of days are 60 here. So 60 by 360, you will get 3 lakh 36,000. This is the investment in receivables. Now we want the return on investment in receivables at the rate of 15% given in the problem. So return on additional funds invested in receivables. So 15% of 1 lakh 84,000 will get 27,600. 15% of 3 lakh 36,000 will get 50,400. These are the return on investment. Now we need the net gain. So in order to calculate the net gain, profit minus return on investment. So profit is how much? 1 lakh 60,000. Return on investment 27,600. So 1 lakh 60,000 minus 27,600, you will get 1 lakh 32,400. This is the net gain from the present policy. In the proposed policy, 1 lakh 84,000 minus 50,400, you will get 1 lakh 33,600. This is the ultimate gain. Present policy, we are getting a gain of 1 lakh 32,400. Proposed policy, we are going to get a gain of 1 lakh 33,600. That means in the proposed policy, the gain is more. So how much additional gain we are getting? 1 lakh 33,600 minus 1 lakh 32,400. 1,200 is the additional gain from new policy. So ultimately suggestion, it is suggested to adopt to the proposed policy of 60 days because our profit will increase by 1,200 rupees. That is the conclusion. So these are the problems on receivables management. 5 problems I have selected for BBA. So if you want to practice more problems on receivables management, I suggest you to go to the videos of financial management for MBA. There I have explained nearly 10 to 15 problems and all examination type problems. So this much is enough. But apart from that, if you want more practice, more knowledge, so apart from this, watch the financial management videos of MBAs. That is already there in my playlist. So if you are satisfied, give a like to the video, share my channel among your friends group so that more students can watch the video. Subscribe my channel if you have not yet subscribed, because my unsubscribed viewers are 60% and only 40% have subscribed. So request to subscribe. It will give more motivation to me to provide more and more better videos, knowledgeable videos, which enhances your knowledge. So inshallah we have completed this receivables management. In the next video we'll start the theory and problems of inventory management.